My income statement says I'm making money, but I never seem to have enough cash. This is a common refrain I hear from business owners as their businesses grow from 1 million, 2 million, up to 3 million in revenue. And the reason is because as we grow and we hit that million, 2 million, $3 million mark, the business becomes more complex. We're hiring employees, we're adding teams, we're adding layers. And as business owners, we're further removed from the day-to-day, and it's harder to keep sight on where money is coming into our business and where money is going out. There's 3 common reasons that I see where business owners struggle with this, and I'm going to break those down for you. So the first reason is not having good processes for managing accounts receivable and accounts payable. So accounts receivable is simply the process of invoicing our customers and then collecting on those invoices in a timely manner. Accounts payable is the process of receiving invoices from our vendors and then paying those invoices in a timely manner. The second reason is debt service. When we buy vehicles or other types of assets, capital assets for the business, equipment, or even real estate, and we're making payments on those purchases over time, those payments suck up our cash flow. But those payments don't show up on our income statement. Well, a portion of them show up. So a portion of every payment is principal repayment and a portion is interest. The interest in those payments does show up on our income statement. The debt payment, the principal payment, lowers the liability on our balance sheet. And so just looking at our income statement is not going to tell the full story of why that debt service is sucking up our cash flow. The third reason is owner draws. So a lot of times owners may take a salary, a small salary, but then they're also taking money out of the business as a form of payment. And when they do, it's called an owner draw or a distribution or a dividend. And those transactions don't show up on our income statement. They're not considered an expense to the business. They're considered an equity transaction. We're taking equity out of the business as a form of payment. And so those are 3 of the most common reasons. And the way that you can better understand those is by utilizing not just your income statement, but also your balance sheet and your statement of cash flows. Most business owners look at their P&L, at least occasionally. Some business owners look at their balance sheet, but very few business owners that I meet and talk with ever look at their statement of cash flows. But that's a really important report that helps us to connect what's happening on our balance sheet to what's happening on our income statement. The statement of cash flows explains where money is coming in and out of the business, broken down into 3 categories. The first is operating activities. So those are your employee payroll, those are vendor payments and things like that. Operating expenses. So that's going to show you how much money we're sending out of the business to pay our operating expenses. The second area is financing activities. That's our debt, right? So when we're taking on debt to buy new equipment or we're making debt payments, those transactions are going to show up on our statement of cash flows. And the third category is investing activities. So those are things like putting money into the business, raising capital from investors, buying assets like land and real estate. Those are transactions, again, that don't show up on the income statement, but they show up on our statement of cash flows. And so when you can put together those 3 reports and look at them in a consistent way on a monthly basis, it's going to transform your understanding of your business, and it's going to help you to understand where money is coming in and money is going out.